Good morning and welcome this morning to Protective Strategies, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I'm joined out there in the chat today by my good friend Michael Fairborn, also an education coach and senior manager, phenomenal educator in his own right. And he's going to be there to help specifically answer questions that you have in the chat. Thank you to all of you for being here with us, as you always are. Some of you always in the chats. We appreciate you being here, as the usual suspects are showing up. We appreciate you being here in the live version as well as in the recorded version. And as we get started today, a couple of things I want to talk about. One is, this is kind of the sunset of this idea of protective strategies, not from a strategy standpoint, not from a usefulness standpoint, but from a webcast standpoint. So we'll talk about that. And we'll talk about what's coming as well and where you're going to find some things that maybe you're used to finding. So kind of a little bit of rearranging, as the Brady Bunch says, when it's time to change, you got to rearrange. And so we're going to do that, a little sha-na-na-na-na-na-na-na. And let's jump into a couple of quick housekeeping items today. Remember, everything we talk about is simply for illustrative and educational purposes only. It is not a recommendation or endorsement of any particular security or strategy. Remember that options carry with them a high level of risk. They're not suitable for all investors. Make sure that you understand the characteristics and risks of standardized options before considering any option strategy. Remember that multiple leg option strategies will involve multiple commissions. Spread trading must be done in a margin account. Remember that American-style short options can be assigned at any time up to expiration, regardless of where they are. European-style options don't get assigned and, in fact, can't be exercised until expiration. We'll talk about that in going forward into one of the new webcasts that you will see. Now, we're going to use technical analysis as we usually do. It's a great way to look at the market. It is not guaranteed. It is theoretical, just like fundamental analysis, just like probability analysis. None of them are guarantees as to what's going to happen in the market. Schwab doesn't recommend the use of technical analysis or any other form of analysis as a sole means of investment research. Now, investing involves risk, including the risk of the loss of principal. We're going to be using the Thinkorswim desktop software platform today. It's not a guarantee of future success out there in the real world. We're going to be using the paper money version. It's a good sandbox to learn in, but it doesn't guarantee translation to the real world either, especially when it comes to the assignment of short options and other things that it does not do relative to a live trading account. Also, remember that past performance of any security strategy doesn't guarantee future results or success, and stop orders, including stop limit orders, don't guarantee the price at which the order will get filled. They simply allow us to specify the activation price, and in the event of a stop limit order, there's the potential for that price of the underlying stock to move around, or whatever the instrument is, to move around the limit area and not get filled at all. So we'll see how that works in this discussion today as well. Here's where we're kind of headed in this discussion. We're going to talk about protective strategies, specifically a couple that might be relevant to what's going on in the market today, since, by the way, it is Fed Day, or the opening entree in Fed Day, and we'll talk about protective strategy applications. We'll look at those applications and examples on the platform. Now, I mentioned that there are changes afoot. And, as I said, the Brady Bunch reminds us of that. Sometimes you got to rearrange things. So what I'm going to do is I'm going to pop up here really quickly our Schwab coaching calendar. So this is at schwab.com/coaching. And as you jump into this calendar, if you go right here to live webcasts and virtual workshops, what you're going to see is a change. If you go over the horizon to January, not very far over the horizon, I might say, you're going to see here on Wednesdays in this time slot a different website, a different webcast, and that webcast is Trading Index Options. So we are sunsetting protective strategies specifically under that name. We're changing the focus of this particular time slot webcast to index options, and that allows us the flexibility to do things like short-term trading, different strategies that aren't necessarily focused on just being protective in nature. So being speculative, using these positions in index options as a hedge, using them to take advantage of changes in passage of time and implied volatility, and in fact, even some sub-daily types of approaches, including 0 days till expiration. And we'll talk about some of those in that in this trading index options discussion. Now, for some of the discussions, and this is going to be relatively advanced discussion. So we're going to kind of come out of the realm of being kind of intermediate, basic to intermediate, and move towards that realm of being advanced in this sense in this particular webcast. But some of the other strategies that we've been talking about, things like protective puts, things like collar strategies, those are going to be covered in a couple of other different webcasts, namely long options. Let me pop back over here to the calendar here. And so if we pop into the full length of this, you're going to start to see long options that Brent's going to teach. You're going to have things like protective puts in that discussion. This one here in the Investing Master Series, James Boyd is teaching, you're going to start to see a little bit more of that collar content as well. And then we have talked on occasion about using futures options or futures contracts as a means to hedge. I'm going to be trading and teaching the Trading Futures webcast on Thursday mornings. And so we'll incorporate a little bit of that hedging using futures into that discussion as well. So you've got some places that you can go to find the things that we've been talking about, but we now have going forward this new opportunity. So we won't have this class for the next 2 weeks because of Christmas Day and New Year's Day. So coming back on January 8th, we will have the first of our Trading Index Options webcast, and I hope to see you all there. Same time, same channel, just a different topic, just a different title, and some exciting new stuff coming up. So I hope that you will join me for that webcast right there, same time in this discussion. So if you want to learn, want to go back and find any of the content that we have done so far, just come over here to the Trader Talks webcast page. By the way, good opportunity for you to click on subscribe right there. And you can click on subscribe down at the bottom of your page as well and subscribe to the Trader Talks webcast channel. But you can just type in protective. You probably even just use that word right there, protective, and you're going to get all of those. You're going to get the playlist. You're going to get protective strategies. You're going to get things like James talking about collars, protective puts, all sorts of other discussions as well, where we talk about this idea of being protective. All right, cool. Now let's jump over to the Thinkorswim platform. Let's take a look at what's going on. Again, quick reminder, click on that subscribe button down at the bottom of the page if you haven't done so already. And that's going to keep you connected to the Trader Talks webcast channel that so many of you participate in, both here in getting the content popped up as well as being able to leave comments and organize and set alerts and things like that. So let's take a look at the SPX. SPX still kind of going sideways here. We are on the start of the Fed meeting, the FOMC meeting, so there is some uncertainty here. And we see the S&P 500 kind of just dragging along this horizontal support level here. A little bit more of a bounce today. It is up just a bit, about 0.26% today. We see the RSI ticking up, but still coming into this kind of bearish divergence context. So not really breaking down, but maybe more of a pause indication here. That's generally the case when we see a bearish divergence in a bullish uptrending stock or a bullish uptrending instrument. The market typically tends to have a bullish inherent bias. The NASDAQ in this case, which drove the market higher on Monday, a little bit of some indecision here in the last couple of candles. Today, maybe a little bit more hammer-like, but a bit weaker still in the RSI. Not a lot of momentum or oomph to the upside, up 0.06 today. So kind of sitting right in the middle, a couple of inside days or Harami-type days, if you will. And then the Russell 2000, which arguably is perhaps or might be the recipient of more impact if, in fact, the Federal Reserve does change interest rate policy, which they're likely to do, at least according to expectations, but that's never a guarantee. They can always do whatever they want. The Russell 2000 kind of sitting back down here to support level on another inside day, just above the 200 or the 50 period moving average here. RSI starting to tick higher, but this is maybe a little bit more bearish of a divergence than what we've seen on the other two indexes, right down to this 50 period moving average. We've seen it bounce once, twice off of that level, almost 3 times off of that level. That might be the expectation, but again, that's never a guarantee by any means. So some weakness and some anticipation of potential uncertainty, and especially if we go over to our VIX grid and we take a look at what's going on in volatility the last few days. Volatility has made this kind of bull flag move, even though VIX doesn't move in context to lines of support and resistance, but it does move in relationship to moving averages and things like that, right? So we kind of see this move to the upside, a little bit of a move back down, still sitting kind of firmly in the 15 handle, which is above the average, kind of right in the middle portion of that range, and kind of bleeding off here, because now the kind of unknown will be known today, and that unknown being what's the Fed gonna do, all right? And if the Fed does something that's out of the ordinary, and leaving rates alone would be out of the ordinary, making a bigger cut than expected would be out of the ordinary. The ordinary would be if they cut the 25 basis points that's really, I think, kind of being expected here. And that would tend to see a little bit of a bleed off in volatility. But because volatility has been slightly elevated, that means that implied volatilities kind of across the board generally are a little bit higher. And, there is that potential for sell-off. But here's the thing. If we look back to previous Fed meetings, especially in this later rate, and Carol, this goes to your question as well, there's been a greater anticipation of uncertainty as the Fed has changed policy, right? Or has the potential to change policy. And that's why we've seen some of these spikes here. We're just not seeing it right now. And part of that is there's kind of some balance, right? The balance is, well, hey, we've got a new administration. The market's been rallying on that new administration expectation. It's also been weakening a little bit, kind of that wait and see, well, what have you done for me lately? Kind of into this FOMC meeting. So if the market is a little bit more hawkish, right? And in that case, maybe greater tightening, right? So, or greater less than expected. Hawkish would be typically meaning more aggressive, right? So if that's the scenario, we could see rates change. But part of the problem is that rates have been kind of doing what they've been doing on their own without the intervention of the Fed. And there are some pundits who've said, hey, maybe the Fed ought to go the other direction, and instead of cutting rates at this point, raising rates as a means to maybe be out ahead of, right? Because the Fed's always generally a little bit late, right? Lesser easing. Yeah, good point. I mean, it's always kind of interesting, right? Thinking hawkish or dovish, lesser easing, right? So lesser easing in this particular case would be holding rates the same, or in fact going the other direction, right? So what would that do? Would that cause the market to sell off? I think there's kind of that underlying current that says, well, wait, if the Fed doesn't feel like they have to cut, then that means the economy is probably in better shape. So it might just digest it, right? And take it in stride. If the Fed comes in and they cut more than expected, then I think the expectation there is that maybe they need to jumpstart the market a little bit more, and therefore the market comes to the realization, oh, things are worse than expected in the economy, and so maybe then at that point we see sell-off. Either way, there's uncertainty, and we see a little bit of that kind of bleeding here, but not a huge amount. So what that means is the individual positions, probably in terms of implied volatility, have not elevated all that much. So let's look at a couple of positions that we've got on here in terms of changes that we might need to make and concerns that we might have. So one of those concerns has been one of the areas in terms of market movement. So we've seen NVIDIA, and I know there was a lot of discussion yesterday in webcasts and elsewhere about NVIDIA kind of coming to that position where it's been in a correction. So what I want to do is I want to look at this position right now. We've got this long stock position in this area right now. I've got a couple of other long stock positions in NVIDIA that are separated into other groups. But right now we've got 100 shares of NVIDIA that were bought at a $60 trade price, and I think that was right after the split. Currently now trading at 135.72, so there's some appreciation in those shares. So let's look at the chart really quickly here for NVIDIA. I'm going to go back to my single grid, and that's just kind of the sandbox that we use oftentimes to play with this. And we'll go to NVDA, right? And so one of the things we've seen in terms of, this is the thing, right? In terms of correction, a correction is typically looked at as down 10%, right? And so we kind of see that move. If we look at where we were from the high to where it is now, how far that percentage drop is, that's about 16%, right? If we take a look up there at the top line on the chart, we can see that that's about a 16% move to the downside. Let's see where we are right now. That's about a 10% move to the downside. So beyond 10%, that's in correction territory. 20% now bear market. We're not there. And I think, if we were to look at this kind of objectively and see what's going on, here's kind of what I see happening here, right? So left-hand shoulder, head, right-hand shoulder, and we see a little bit of an excursion to the downside. But I would argue that excursion to the downside kind of comes right in the middle of this kind of big, wide horizontal support level. So has it broken the neckline? No, not yet, right? RSI is still kind of moving to the downside, although it's ticking up, right? So we have those lower lows, lower highs in RSI. It's kind of bearishly diverging. But at the same time, it's not really bearishly diverging, because we could probably argue that this is the right-hand side of this head and shoulders pattern, which is kind of a descending triangle, which oftentimes, in the case of a bullish move, if we get a break of the RSI and a break of this trend line, can be an indication of some upward movement, symmetrical upward movement. On the other hand, if it breaks to the downside, we probably have that potential for, let me clear this annotation, we probably have this potential for the move back down from a symmetrical standpoint. If that's the symmetrical move, making that move down here to the support level just above the 110 mark, right? So many traders, some traders might have already hedged this position with a collar. AP 514 indicates that's the case in their particular circumstance, and looking at offsetting potentially some of that move. So what I want to do is think about what's going on with the Federal Reserve and kind of wrap back into this whole discussion, right? And so if we see changes in the market, this is the whole reason why, or one of the reasons why, traders put protective strategies onto positions, is to offset event-driven or specific event risk. And so what I want to do here in this particular case is do that, and we'll look at hedging this. We've done it before in this particular position when there have been impending changes afoot, right? So the RSI right now down here at the bottom, this is the RSI. RSI is at 46. The other thing I'm going to put on here is IMP, implied volatility as a whole for this stock, right? So we'll put implied volatility on here as well. And one of the things that you notice is that implied volatility is relatively low. I mean, relative to what the stock has been doing, relative to this little bit of a pullback, we've just not seen a lot of implied volatility bleeding back in here. But remember that this is the average, right? This is the average implied volatility. Okay. if we were to look at the trade tab and we were to look at the option chain and we were to look at these individual expirations over on the right-hand side, then you're seeing that implied volatility, to be fair, this implied volatility right now in this kind of 9 days to go until expiration is relatively low relative to the rest of these expirations. So that's post the Fed meeting. This one that is current, the 2 days to go until expiration, is the only one that's really, truly elevated because of that event risk. And we've got a couple of days to go until expiration. So we could look at protecting over the next 2 days and creating a caller trade to protect against those next 2 days. And oftentimes what we might see is that when we see that short-term elevation of implied volatility, we may get a skew one way or the other, right? And that skew might make the calls a little bit more expensive if there's more demand for calls. The puts a little bit more expensive if there's more demand for puts. But that skew oftentimes happens, especially when there's elevated implied volatility. And sometimes in constructing a caller, we can take advantage of that skew. So what I want to do is I want to look at this option chain for 2 days to go until expiration. Stock's currently trading at 35. That means our 130 at 135. That means our 135 is the at the money strike. So what I'm going to do is I'm going to go equidistant. So if our 135 is our at the money strike, I'm going to go 1, 2, 3, 4 strikes. Actually, I'm going to go 3 strikes. That's going to put us at about the 30-cent delta. I might even go a little bit more. Let's go 4 strikes. So my 132 strike, 4 strikes out from my at the money strike, currently trading at about $1, maybe $1.01, right? And if I go 1, 2, 3, 4 to the 139 strike, that's currently trading at about 88 cents on the call side, right? So here's what's happening. If we look at equidistant strikes, that one right there, the 139 strike versus the 132 strike on the put side, the 132 put strike is trading at a little bit more. It's equidistant from the 135, from the at the money strike. It's trading at a little higher premium than, and they're actually kind of really close here, than the 139 strike, right? So we've got a little bit of parity that skews a little bit to the put side, which means that the puts are going to be a little bit more expensive, which means that in order to create a no-cost caller or a caller at a credit, we could do it right here. It's going to be fairly low cost. Or we could go in 1 strike on the call side and bring in a little bit more premium to the 138 strike. But what that does is it limits the potential upside. So let's look at where those levels are: 138, 139, and 132 on the downside. So we'll go back to our chart and we'll kind of bring this in. I'm going to kind of squish down these lower panels just so we've got them there, we can see them. But I want to focus more of the attention right here on what the price of the stock is doing. So 132 on the put side is kind of right there on that support level, kind of right at that level of support. Okay. And 139 is right up here. All right. 139 is right up there. Not a very big range in which we've created this collar, but we're only doing it for 2 days, right? And the intent is to protect the position. But I'm a little bit concerned in this particular case, given the fact that there could be some upside potential movement here. I'm probably a little more concerned about, in this case, losing a position or having a position called out that has a trade price of $60 that's currently trading at about 135 than I am about seeing the stock move to the downside. So what I want is an option that has, or a chain that has, a little bit more of a call skew or a bullish skew, right? So what I'm going to do is I'm going to go out to this 27D expiration, and we're going to do the same exercise here. Price of the stock's currently sitting at 135. And, you know, I mean, we're still kind of sitting right here at about this 135. Okay. So market maker move in this case, $3.28. So I'm going to go to the 135 strike. That's my at the money strike. I'm going to go 1, 2, 3 strikes, 4 strikes to that 131. That's about the 30-cent delta. It's priced at $1.83, $1.84. And then if I go the other direction, 1, 2, 3, 4, that takes me to the 139 strike. Notice that that's trading in a little bit more. We've got a bit of a call skew here. In this case, bringing in a little bit more premium. So where can I go? I can go out to the 140 strike and bring in a little bit more premium to offset that 131 strike. Now, the other thing I could do is I could go to the 139 and the 132, so bring the put up a little bit, but I don't necessarily want to do that because I'm more concerned about the stock going up than I am about it necessarily going down in this particular case, especially since I would have a protective put on in either case, and we're talking about a range of $1. So I'm going to go out to the 140 strike. That's going to be kind of outside that market maker move, right? So outside the typical range. So this would be an extreme move or an unusual move. And so in this case, I'm going to look at buying the 131 put. So that's going to create our protective put in this scenario, right? Buying the protective put, 131 put. So we're going to buy that one. I'm holding my control key down on my keyboard, and I'm going to come over here to the 140 call option. Gives me a little more headroom, same place that I was before at the 131 put option for the protective put. Now I'm going to sell the 140 put, or excuse me, the 140 call to offset. And basically it's a collar, a no-cost collar, in fact, a collar with a little bit of a credit. Gives me some range, gives me another $1 of upside move outside the market maker move. And in this particular case, allows for a little bit more headroom and a little bit more time post-event to maybe move this position if I need to roll it down and kick it down the road. Why the count of 4 up or down? Because in this particular case, that was taking me just about, Ambrose, out to about that 30-cent delta, which is one standard deviation away from the midpoint, right? Typically. Could I go much further out? Yes. Could I go further out on the call side? Yeah, absolutely. We could make this a much wider caller, but then its effectiveness to the downside diminishes a little bit, right? And we're talking about a shorter period of time. If we're talking about a longer period of time, I'm probably going to make that collar wider, right? Think about this. If you've got to wear a stiff collar and a tight collar, you want to wear that tight collar for as little amount of time as possible, right? Just in comfort's sake. If I've got to just hang out all day long, and I want to probably wear a t-shirt that doesn't have a collar on it, right? But if I'm going to wear a stiff collar or a tight collar, in this case, I want one that's relatively short term, okay? All right, so as we look at this, now we're getting a little bit more credit. It's going to kind of bounce up and down here. We're going to go ahead and confirm confirm and send here. We're going to read through this. Now remember, this isn't technically a spread, even though we are trading two options. We're buying a put option and we are selling a call against long stock because we have 100 shares of the stock, right? So this is essentially, and we're going to put this in our protective strategies group, even though we're putting it together as a combo, this is a long put and a short call against long stock. So it's not technically a spread in that sense. Cost of the trade here, we got to make sure that we're aware of any transaction costs and those types of things. But there's that structure. We're creating this trade. We're selling this 140, 131 caller against that long stock position. Make sure that we're aware of that. We're going to go ahead and send and fire that order off. And now we've got that. Now, we could go longer in time, right? We could go longer in time. And if we were to go out to, say, for instance, the 17 Jan, that's 30 days to go, a little bit more elevated. But the thing about it is, if we go out that far, now these puts start to become at those same strikes. Plus, we don't have the same granularity in this particular case. Now those puts become pretty expensive. The calls, maybe we get a little bit more headroom to the upside there. But now I'm tied into that caller for a longer period of time. Right. So we're primarily, callers oftentimes, and we've talked about this, oftentimes are used to address specific event risk. And that's what we're looking at here in this particular case. The next earnings announcement isn't over until over the horizon in February. The Fed meeting is the next one. But as Carol points out, there's always the potential for news, right? But the thing about it is, you don't necessarily always want to have, a trader might not always necessarily want to have a collar on, because you want to be able to take advantage of upside movement without that limitation, right? So there is that possibility. So Naresh, personal preference really is what it comes down to, is the length of time that we're in that collar. But here's what we've got now. We've collared it up right to that 131 and then out to 140, giving it a little bit of room to move kind of within that market maker move and that expectation there. So that's what we're looking at here in this particular case. Let's go back to the monitor tab and let's take a look at a couple of these other positions that we have on board. And there's one that I was kind of excited to adjust because I wanted to bring this out. And we talked about this a couple of weeks ago. And this was the Johnson & Johnson short collar. Normally we think about creating a collar on a long stock position. But in this particular case, we happen to have a short Johnson & Johnson position, right? And we had collared that short Johnson & Johnson position. So let's go to the chart really quick and take a look at J&J. So we had a short position, and that short position was to take advantage of this downward move. It might also have been an inadvertent short position that came as a result of an inadvertent short call, and we didn't own the shares, and so we ended up with a short call position in our portfolio. All right. And the idea is the short transaction took place. If we look at this, the short transaction trade took place at 159. The stock's currently trading at 146. So there's been a little bit of gain in that short position. Now remember, I have to call this out. We're not talking about shorting, and I'm not advocating shorting. But here's the thing: that if to trade a short position, that requires trading in a margin account. There's going to be borrowing costs, and the stock itself, shares of the stock itself, have to be available to borrow in order to be able to short those shares. And there's theoretically unlimited upside risk, right? Because the price of the stock could go up indefinitely. There's no upward bound. So we put the collar on to kind of manage this short position. And the idea being that if the price of the stock goes up, well, now we've got if we think about it, if we've got to buy the stock, what gives us creates the obligation to buy the stock? And that is a short put, right? And if we're protecting against the price of the stock going further to the upside, now we want that position to be able to have the right to buy the stock at a specific price. So we go back over here to the monitor tab. We take a look at the combo that creates this short collar, and that is a short put at the 150 strike, which gives us the obligation to take delivery of the shares at 150. So the stock's currently trading below that level, which means that that's now in the money. And we have the long call at the 155 strike, which gives us the right. That's kind of the protection, right? That gives us the right to protect by buying the shares at 155. That's kind of the absolute upward limit. If we were to exercise that call, buy the shares at 155, we close that short position at 155 with potentially a little bit of profit in the trade, theoretically. Now, here's the thing. Since this is paper money, paper money does not facilitate the early assignment of short options, right? But this is an option that is in the money by about $5, right? $4 theoretically, right? $4. So in a live trading account, in all likelihood, this may very well have already been assigned early. No guarantees of that, but it very likely could have been, right? So assigned early. It's got some intrinsic value, right? In fact, it's got about $4 of intrinsic value. And to sacrifice any extrinsic that was in there, that may be beneficial for whoever was long that put option. Having the right to sell the stock at 150, if it's trading at 146, that has value. So we're kind of in a position where in reality, this probably would have already been taken care of or would have been put to us. And if that's the case, put to us, and we would have ended up closing the short position at 150, right? not getting the maximum gain. So here's the thing to think about. We could, because we're short this position, just simply hold on to this through expiration and allow that to be assigned to us, right? Allow the stock to be assigned to us at 150. But you know what? Here's the thing. Stock's trading at 146. The option itself is trading at $3.87. If we were going to buy this back, we could buy this back, buy that put option back, and then choose to use cash to buy the stock at 146, close out the short position and eliminate the that short position, and then just simply let this long call roll off and expire worthless, which it's essentially worthless at this point, right? Okay. Now we could roll this a little bit, right? But I'm going to look at the scenario here of managing this by choosing to not exercise this right at the 155 call, because that would be buying the stock a lot higher, right? I'm going to let that one expire, but I'm going to buy back this put option and eliminate that, and then we're going to put in an order to buy the stock, okay? And take this trade off, take that short position off, because if we look at the chart, it's starting to move to the upside again. So what I'm going to do is I'm going to right click and I'm going to do this. I'm going to create a closing order, and I'm going to buy back that short option, okay? I'm going to buy back that short option. Now, here's the thing. We've got to remember this. Buying back this short put, when I put that short put on, I was willing to hold the cash to buy the underlying stock. So I've got the underlying the cash in the account to buy the underlying stock to close the short position. So that's not an issue in this particular case, because remember, this wasn't a spread, and it's not a spread. So I'm going to go ahead and I'm going to click on confirm and send, and we're going to read through this order, make sure that's what we want to do. We're going to close this one down. This is to close the position. So we've closed that short put option. So that's not going to appreciate anymore. But we're still short. We're now still short this stock, with the stock trading at 146, and it's starting to move higher. So we could very simply just create an order to buy the stock and eliminate that and close this position down. Let this one expire worthless, because we're not going to get necessarily much out of this. And it really isn't. I mean, this was designed to be there as a protective position anyway. We weren't looking at making money on that hedge. So that's a sunk cost into the trade. So now at this particular point, what we might do is just simply initiate an order to close this short position where it's currently trading. The other thing we could have done is rolled this down a little bit, but in the interest of potentially just demonstrating this, I'm going to create a short or a closing order. We're going to buy back the stock, and this is going to serve to close out that short position. This is a closing trade, not a buy, not a purchase to initiate a new position, because we're short the stock by 100 shares. So I'm going to click on confirm and send. We're going to read through that order. We had the cash held already. We know that. And we're going to go ahead and we're going to click on send and fire that order off. And we bought the stock. Now we've eliminated the short position. Now what we should be left in this particular case is just simply this long call. So if the price of the stock, look, if we leave this, it's got 2 days to go. If the price of the stock does take off and move to the upside, that's a flyer, right? I mean, that's just there, and it could appreciate, probably not. We don't have a lot of time left in that 2 days to go until expiration. So if the price of the stock does make a move upside, is maybe this gains a little bit, we could sell it back. Downside is, well, we've already accepted the risk here in this trade. Now, it could end up being in the money at expiration. The stock could have to move to 155 or above. And in that particular case, that option is going to have some intrinsic value or have some maybe increase in extrinsic value as we get close to expiration, but not a lot. So we could close it out positively, but we don't have an obligation there. So it's simply now essentially a flyer, right? Okay. All right, so there's that one. We've kind of managed that position. And then the other one that we have that I wanted to take a look at managing here really quickly is this one. We've managed the Johnson & Johnson. We've got this McDonald's caller out here. Actually, it's this one. It's the Coca-Cola one that I wanted to look at. So we're long Coca-Cola. the stock's moving higher. We've got 9 days to go until expiration on this put option. That put option is at the 62 strike. The stock's currently trading at 63. This is now trading for about 18 cents. So there's still a little bit of extrinsic value that we could salvage in this, and we could create a collar on this. Let's go to the chart for Coca-Cola here really quickly. KO. Stock's kind of bouncing here, putting that long put on here, but we could come up and see if we could get some premium for selling that 165, or excuse me, selling that 65 call. That's where that kind of next level of resistance is overhead. So let's see if we can do that. Let's go back here to the trade tab. We're at 9 days to go until expiration. In this case, I'm going to go out to maybe the 10 Jan expiration, a little bit, not really elevated implied volatility here in this particular case. Where do we see some elevated implied volatility? Maybe out to the 17 Jan is a little bit higher. And that's probably because there's an earnings announcement out there. But there's not a lot of liquidity here because it's very likely that there's more liquidity in those weeklies. But we've got that call or the put option here at the 62 strike. So let's see where we have that put option now. There's the 62. We don't have a 62 out here. So we could roll to the 60 or to the 62 half, maybe roll it up a little bit, and then sell out to, what did we say, the 60, 65. So let's go back to the trade tab and see if we can create this collar. If we sell the 65 and we buy the 62 half, we're tightening that up a little bit. We're giving it a little bit of room to move, still outside the market maker move within that time frame, and we're continuing to protect that position. So what I'm going to do is first go back here to the monitor tab. I'm going to close this one down and see if we can salvage. We could just roll this. Let's create a rolling order first. So we're going to roll this, and we're going to do this out to that means buying back the one that we're short currently, or the one that we're long, excuse me, selling back the one that we are long, and then buying another one. So let's go out to the 17 Jan. And we know that we don't have a 62, so we're going to have to go to a 62 half. And we're going to roll that for a little bit of a debit. That's fine, 59-cent debit. And so we're going to do that one first. We're going to create that order, roll that one out first. Remember, rolling's not a magic wand. It doesn't eliminate transaction costs. So we rolled that out. And now what we're going to do is we're going to create the collar by selling the 65. And so we're just going to go sell the 65. And we're going to create this collar, click on confirm and send, make sure that it's going to the right place, to our protective strategies, and read through the order, make sure that we're aware of any transaction costs. So we're going to sell that one. Now that one's sold. And we actually came up with a little bit of about a 25-cent net credit on creating that order. But what we've done is we've pushed that out a little bit, that protection out, given ourselves a little bit more room to move to the upside, and brought our put option a little bit tighter to the downside. So we're tightening up a little bit, but we're giving the stock all the way up to that 65 resistance level to move. And this is, again, well within that market maker move. So just a couple of different ways that we can adjust these positions. All right, guys. Tempt me with a cute cobra. Yeah, gosh, thank you, Carol. Guys, thank you so much for letting me spend these weeks with you in our protective options webcast. My thanks to Michael Fairborn for helping out. Thanks to all of you for your feedback and for your suggestions and ideas. And we'll see you next month, the 8th, for index options. And we'll talk a little bit about more of some of these strategies as well. Guys, thanks again, and thanks to our production staff, and thanks to Mike Fairborn for helping out. We'll see you again very soon. Have a great holiday, everybody, and take care. Bye-bye.